Many believe they're struggling financially because they don't earn enough. But what if the real reason isn't your income, but something far more insidious, silently eroding your wealth? Data shows over 60% of Americans live paycheck to paycheck, regardless of their salary bracket. It's not just about earning more. It's about what happens to every dollar you earn. Whether you're a tech worker with stock options in Silicon Valley or a day trader in NYC, the same invisible forces are at play, shaping your financial destiny. A recent survey revealed 72% of millennials cite financial stress as their top concern, impacting health and relationships. This isn't a problem of not working hard enough. It's a systemic issue rooted in deeper behavioral patterns. The lifestyle creep is a silent killer. As your income rises, so do your expenses, often subconsciously. That new luxury car or larger apartment can quickly turn a raise into a financial treadmill, preventing any real wealth accumulation. Easy access to credit cards and personal loans creates a debt trap. The average American household credit card debt reached $6,750 in 2023. This isn't just a number, it's interest payments stealing future opportunities from your investment portfolio. We live in an on-demand economy. The desire for instant gratification, from next-day delivery to immediate entertainment, often sacrifices long-term financial growth. Every impulse buy is capital not invested, not compounding. Consider the opportunity cost. If you spent $500 less per month on discretionary items and invested it in the S&P 500, historically averaging 10% annually, you could accumulate over $1.01 millers in 30 years. That's the power you're forfeiting. Sometimes, spending isn't rational, it's emotional. We use money to cope with stress, celebrate, or even validate self-worth. Understanding these underlying psychological triggers is crucial to breaking the cycle of overspending. Many blame external factors, the economy, their boss, inflation. While these play a role, true financial freedom begins when you shift from an external to an internal locus of control. Your choices, not just circumstances, dictate your wealth. Despite living in the most advanced economy, financial literacy remains shockingly low. Only 57% of American adults are financially literate. Without understanding basic budgeting, investing, or debt management, wealth building is an uphill battle. The belief that more money solves everything is a dangerous myth. Silicon Valley professionals earning $300,000 often find themselves just as financially stressed due to escalating lifestyles and poor money habits. It's about management, not just magnitude. The illusion of wealth is pervasive. Leasing a luxury car, owning a massive house with a huge mortgage, or frequent lavish vacations can project affluence, but often hide a fragile financial reality built on debt, not assets. This is playing rich, not being rich. While your money sits idle in a checking account, inflation is silently eroding its purchasing power. With inflation rates recently hitting 9.1% in 2022, every year your cash isn't invested, it loses significant value. It's like a leaky bucket. Social media fuels the comparison trap. Seeing curated highlights of others' lives creates pressure to spend money you don't have, on things you don't need, to impress people you don't even truly know. This cycle is financially destructive. Recognizing these underlying reasons is the crucial first step. It's about shifting your mindset, understanding your financial psychology, and reclaiming control. The path to true wealth begins not with more income, but with better decisions. After understanding your financial psychology, the first principle to master is the power of compounding. Albert Einstein reportedly called it the eighth wonder of the world. Consider investing just $100 monthly into an S&P 500 index fund. Over 30 years, at an average 10% annual return, that small sum could grow to over $226,000, not just from your contributions, but from earning returns. This leads to the crucial distinction: time in the market beats timing the market. Constantly trying to predict tops and bottoms often results in missing the best performing days. Data shows that missing just the 10 best days in the S&P 500 over 20 years could have your returns. Consistency, not speculation, is your ally. Building on consistency, diversification isn't just a buzzword, it's risk management. Spreading your investments across different asset classes, stocks, bonds, real estate, even alternative assets mitigates the impact if one area underperforms. Ray Dalio's all-weather portfolio philosophy champions this to navigate various economic conditions, aiming for steady returns. However, diversification must align with your personal risk tolerance. Are you comfortable with 20% market swings like tech stocks, or do you prefer the stability of government bonds? Understanding this is key to avoiding emotional selling during downturns. A portfolio that keeps you up at night is incorrectly structured for *U*. One often overlooked risk is the cost of inaction inflation. Your savings sitting in a low-interest bank account are losing purchasing power daily. With current inflation rates around 3–4% in the US, $100,000 today could be worth less than $70,000 in 2 decades, if not invested. This silent tax erodes your future wealth. Beyond inflation, our own behavioral biases are often our worst enemies. Loss aversion, for instance, makes the pain of losing $100 feel twice as intense as the pleasure of gaining $100. This often leads investors to sell winners too early or hold on to losers for too long, sabotaging long-term gains. Recognize these patterns in yourself. To counter behavioral pitfalls, consider passive investing via index funds and ETFs. Investing in an S&P 500 ETF like SPY or VOO means you own a tiny piece of the 500 largest US companies, automatically diversified, at low cost. Historically, the S&P 500 has averaged 10–12% annual returns, outperforming most actively managed funds over the long run. But even the best strategies need a roadmap. A comprehensive financial plan isn't just about investing. It defines your goals: buying a home, funding college, or early retirement. It sets clear milestones, allocates resources, and accounts for life's inevitable changes. Without a plan, you're sailing without a compass, easily swayed by market noise. And before any investment, solid foundations are critical. That means building an emergency fund covering 3–6 months of living expenses, and aggressively paying down high-interest debt, like credit card balances, often exceeding 20% APR. Think of it as guaranteed returns, because avoiding 20% interest is like earning 20% risk-free. Don't build a mansion on sand. Once your foundation is secure, consider diversifying your income streams beyond your primary job. This could be a side hustle, rental income, or dividend stocks. For example, a tech worker in Silicon Valley might use their skills for freelance projects, adding $1,000, $2,000 monthly, which can then be invested, accelerating wealth creation significantly. Understanding market cycles is equally vital. Bull markets, like the post-COVID rally, feel euphoric, but bear markets, though painful, present opportunities. Smart investors like Warren Buffett often say to be fearful when others are greedy, and greedy when others are fearful. Recognizing these cycles helps you avoid panic selling and instead buy low. This discipline extends to your daily spending. Every discretionary dollar spent on immediate gratification, a new gadget, an expensive meal represents an opportunity cost. That $500 iPhone upgrade, if invested monthly into an S&P 500 ETF, could be worth over $5,000 in just 5 years. The choice is yours: instant pleasure or significant future wealth. For US investors, leveraging tax-advantaged accounts is a powerful strategy. Maxing out your 401k or Roth IRA not only reduces your taxable income now or in retirement, but also allows your investments to grow tax-free or tax-deferred. A 25-year-old contributing $6,500 annually to a Roth IRA could accumulate over $1.5 million by age 65, all tax-free. The financial landscape is ever-evolving. Continuous learning isn't just a suggestion, it's a necessity. Whether it's reading books by financial giants, following reputable news, or analyzing market trends, staying informed empowers you. The market doesn't care what you knew yesterday, it rewards what you understand today and prepare for tomorrow. Ultimately, the real reason you're broke isn't a lack of money, but often a lack of understanding and consistent action. By applying these core principles, compounding, diversification, managing biases, and strategic planning, you shift from being a spectator to an active architect of your financial future. What steps will you take today? Now that you understand the principles, it's time to transition from theory to tangible action. Building wealth isn't abstract, it's a systematic process of executing a well-defined financial blueprint. Let's outline the practical steps to become the architect of your own financial freedom. First, master portfolio allocation. For instance, a common strategy for a 30-year-old might be 70% equities in low-cost S&P 500 ETFs like SPY, 20% bonds, and 10% cash/alternatives. Adjust this based on your risk tolerance and age, but always prioritize diversification. True diversification extends beyond just stocks and bonds. Consider real estate through rate, commodities like gold, or even a small, calculated venture into alternative assets if suitable. Geographically diversify to mitigate country-specific risks. A common mistake is being overexposed to a single market. Risk management is your portfolio's shield. Implement a margin of safety by only investing in assets with intrinsic value below market price. Practically, this means using stop losses to limit downside, e.g., a 10% stop loss ensures you never lose more than that on any single position. Position sizing is also crucial. Rebalancing your portfolio annually or biannually is non-negotiable. This systematic process forces you to sell assets that have performed well and buy those that have lagged, effectively buying low and selling high. This discipline can significantly outperform a static portfolio over decades, ensuring your risk profile remains consistent. Don't let taxes silently erode your returns. Maximize tax-advantaged accounts like your 401k and IRA, choosing Roth for future tax-free growth or traditional for immediate deductions. Understand capital gains implications and explore tax loss harvesting. A Silicon Valley engineer can save thousands annually with smart tax planning. Understanding market cycles isn't about timing the market, but about strategic positioning. Recognize the phases: expansion, peak, contraction, and trough. During downturns, when others are fearful, a disciplined investor sees opportunity, like buying during the 2008 crisis or the 2020 dip, yielding significant long-term returns. Cultivate multiple passive income streams. Beyond capital gains, dividends from blue-chip stocks, rental income from real estate, or royalties can create financial independence. A portfolio generating $50,000 annually in dividends allows a FIRE enthusiast to cover significant living expenses, accelerating retirement goals. Before any investment, rigorous due diligence is paramount. Don't chase hot tips from social media. Instead, analyze financial statements, assess management teams, and understand competitive landscapes. Remember the GameStop saga? Many lost heavily because they invested based on hype, not fundamentals. Research protects your capital. Even with a solid plan, your emotions can be your biggest enemy. Behavioral finance teaches us to acknowledge biases like loss aversion and herd mentality. Implement rule-based investing, journal your trades, or even have an accountability partner. Investing is a marathon against your own mind, not just the market. The true magic of compounding lies in time in the market, not timing the market. Consider this: $10,000 invested in the S&P 500 for 30 years could grow to over $200,000, while only 20 years might yield half that. Consistency and patience are your most powerful allies for long-term wealth accumulation. Beware of common pitfalls: chasing past returns, excessive day trading, or over-leveraging. Historically, over 80% of active funds underperform their benchmarks over 10 years. Don't be swayed by short-term gains or the illusion of quick riches. patience, and a long-term view consistently yield superior results. For complex situations, building your financial team is invaluable. A certified financial advisor can help with planning, a tax professional with optimization, and an estate planner with legacy. You don't need them all immediately, but for significant wealth or intricate needs, professional guidance offers peace of mind and expertise. Remember, your financial journey is iterative. Markets evolve, personal goals shift, and new opportunities emerge. Regularly review your portfolio, adjust your plan as life changes, and embrace mistakes as valuable lessons. Think of yourself as a financial gardener, constantly tending to your growing wealth. The real reason you might be struggling isn't just about income, but about implementing a disciplined strategy. You now have the blueprint. The most crucial step is to start today. What's one actionable step you'll take towards securing your financial future? Share your commitment in the comments below.